When a market approaches the edge of its trading range, most traders see nothing more than a line on a chart. But the trained eye understands that price is revealing its intent. It is speaking in the same old language it has used for centuries, the same language I spent years studying. And if you learn to read that language, you can trade breakouts with the calm confidence of a seasoned operator. Now tell me, have you ever watched a market break a level only to wonder whether it was a genuine move or just another false start designed to shake you out? You must remember that price action is the purest indicator we have. Long before the modern trader cluttered charts with oscillators and colored signals, price alone told the story. A breakout, when it is real, tends to form on the back of accumulation or distribution. It is not random. It is the result of force building in the market. When price approaches a level several times and refuses to retreat far, that is the market showing its hand. It is coiling. It is preparing. Do you notice how much strength the market shows when it refuses to fall even after the bears make multiple attempts? Many traders chase breakouts the moment price pokes its head above resistance. But you must train yourself to judge not the first movement, but the underlying character of the move. A true breakout is orderly. It follows a rhythm. It moves with purpose, not chaos. The bars leading into it often become tighter, the swings shorter, the pullbacks shallower. If you only look closely enough, the footprints of accumulation are always there. Have you ever compared the breakout that succeeds to the one that fails and noticed how the price bars tell two entirely different stories? When I studied the great markets of my time, cotton, wheat, railroad stocks, I came to understand that price respects structure because it reflects human nature. People act on fear and hope, and they repeat the same mistakes. Breakouts happen because enough traders finally agree on direction. But the smart operator does not enter simply because price crosses a line. He waits for confirmation through behavior. A market that breaks out and closes near the high has strength. A market that breaks out and immediately retreats shows weakness. This is the difference between a professional entry and an amateur one. And I must ask, how many times has impatience cost you more than any bad setup ever did? A breakout is not just about direction, it is about timing. Markets move in cycles, and a level that has not been tested long enough carries no real weight. When a market moves between support and resistance for days, weeks or months, it builds a pressure that must eventually release. Price does not move in straight lines for long. It expands and contracts like breath. Trading breakouts requires you to feel that expansion coming. You must ask yourself, is the market stretching itself thin, or is it simply gasping before the next wave? Consider also the pullback after the breakout. Many traders fear it, believing the move is failing. But more often than not, that pullback is the final test, the market ensuring it has the strength to continue. Professionals welcome the pullback because it shows whether the previous resistance has now become support. A market that respects the breakout level and moves higher afterward confirms the intent behind the move. Have you ever noticed how the best breakouts usually give you a second chance if only you wait for it? Your mindset plays just as important a role as the chart. Trading breakouts requires patience, discipline, and a willingness to do nothing until the market shows its hand. You cannot build wealth in the markets by acting on impulse. You build it by following principles. One of the greatest principles is this: never anticipate a breakout. Let the market prove it. Many traders lose money not because their idea was wrong, but because they acted too soon. And I wonder, have you learned to let price come to you rather than chasing it? A professional trader accepts that not every breakout will lead to a sustained move. Some will fail, but if you read price action correctly, you can usually sense when the market lacks conviction. A breakout without volume, without follow-through, without tight structure, this is not a breakout worth trading. These are the situations where money is lost not by the market's movement, but by the trader's refusal to wait for clarity. It is in the waiting that wealth is built. Do you see how waiting for quality setups could have saved you from many losing trades? And remember, a breakout is never the beginning of a trend. It is the confirmation of one. The trend begins in the quiet stages, the consolidation, the pause, the narrowing ranges. When price finally breaks, it is simply revealing the trend that has already been forming beneath the surface. This is why patience is rewarded. By the time the crowd sees the breakout, the professional has already prepared. Do you prepare or do you react? Once you learn to read the signs, tightening ranges, higher lows pressing against resistance, hesitation candles that reveal the last struggles of the opposing side, you begin to trade not on hope, but on evidence. You begin to see the market the way the old traders did, not as a place of chaos, but as a place of rhythm and natural order. Your goal is not to catch every move, but to participate in the moves that show clarity, harmony, and strength. Ask yourself, what would happen to your account if you only traded the cleanest breakouts and ignored everything else? When you view the market through this lens, trading becomes not a game of prediction but of observation. You observe how price behaves at key levels. You observe how it responds to pressure. You observe whether the market respects prior structure. Your job is not to force the breakout. It is to recognize when the market has gathered enough strength to move with conviction. And once you see that strength, you act with confidence because the price action itself has confirmed your belief. By developing this approach, you begin to think like a professional. You begin to treat each breakout as a test of structure, of trend, of conviction. You begin to trust the market's signals more than your emotions. And that shift in mindset is what separates the trader who survives from the trader who merely gambles. So as you study your charts, watch carefully how price behaves at the edge of the range and ask yourself whether the market is whispering a warning or revealing an opportunity. When you hear traders talk about breakouts, they often imagine the moment price punches through a line on the chart as if it was some sudden burst of energy. But a true breakout seldom comes out of nowhere. It is built slowly, layer by layer, through accumulation or distribution. That is the quiet phase where the market prepares its next major step. And if you learn to read that preparation, you no longer feel surprised by breakouts. You feel ready for them. Think back to the last time you saw price drift sideways for days or weeks. Did you recognize that the market was gathering strength, or did you overlook the clues hidden in those small fluctuations? Accumulation is the process where strong hands quietly buy from weak hands. The public loses interest, volatility fades, and volume may seem modest, yet price refuses to decline. That refusal is the first sign. Markets do not hold steady by accident, they hold because someone is absorbing supply. Every time the price dips and then returns to the same level, it is revealing that selling pressure is no longer dominant. Each low becomes a footprint, a sign that demand is gradually taking control. And have you noticed how a market under accumulation seems almost impossible to push downward, no matter how many small attempts appear? Distribution is the opposite. Instead of strong hands absorbing supply, they are unloading inventory, often while the price still looks healthy. It moves sideways, not falling dramatically, because while buyers are still present, they are being slowly overwhelmed by quieter selling. The market appears calm, but those who know how to read price action see the exhaustion setting in. Rallies shrink, rejections grow sharper, and the ceiling becomes firmer. This is the foundation for a downside breakout. How often have you mistaken this type of consolidation for strength when it was actually the calm before the decline? The key insight is this: breakouts do not begin with the breakout itself. They begin with the process that creates the imbalance. Accumulation builds the energy for upward breakouts, while distribution builds it for downward ones. When traders do not pay attention to these phases, they treat breakouts as isolated events. But when you understand the build-up, the breakout becomes the natural conclusion of the story, already unfolding on the chart. During accumulation, price often forms a series of higher lows pressing repeatedly against a horizontal ceiling. Think of it like a pressure cooker. Each time the market rebounds off a higher floor, the buyers show their determination. They step in earlier each time. Meanwhile, the sellers at the top are being tested again and again, and eventually their supply thins. The market becomes tightly wound. The breakout is simply the moment when the remaining resistance finally gives way. Can you recall a time when the market kept touching the same resistance until the final attempt finally broke through? In distribution, the reverse is true. Lower highs press against the same support line. The selling pressure appears subtle yet persistent. Buyers lose enthusiasm, unable to push price back to previous highs. It is not the dramatic movement that reveals the weakening market, but the lack of strength in the rallies. Each attempt becomes feebler, signaling that demand is fading. When support finally breaks, it is because too many buyers have been absorbed and the remaining ones cannot hold the line. Have you ever noticed how a level that looked strong for weeks can suddenly give way once the market has worn itself out? Another important aspect of accumulation and distribution is time. A level tested only once or twice does not carry the same weight as a level shaped over many sessions. The longer the market stays in balance, the stronger the imbalance becomes when that balance is broken. A breakout occurring after extended consolidation often travels farther because it represents a deeper shift in control. Quick breakouts after minimal consolidation are more prone to failure because there was no meaningful build-up. Have you ever taken a breakout trade only to see it fail immediately because the market hadn't truly prepared for it? Price action inside these zones often becomes tighter as the breakout approaches. The swings shrink. Candles grow smaller. Volatility contracts. This is not random behavior. It reflects a market where opposing forces grow increasingly balanced until one quietly gains dominance. When the imbalance is finally resolved, the breakout appears sharp and decisive because the pressure has been building for so long. If you learn to recognize this tightening behavior, you can anticipate high-quality breakouts before they occur. Have you ever watched a chart compress so tightly that you could almost feel a strong move coming? The psychology behind these phases is simple but powerful. During accumulation, fear fades and confidence grows. Traders who were uncertain gradually become willing buyers. During distribution, confidence fades and caution rises. Traders who were enthusiastic begin to hesitate, providing opportunities for stronger hands to offload positions. All of this is visible in the price itself. You do not need indicators to see it. You only need to watch how price behaves around the same levels over time. When you put all of this together, breakouts start to feel less like surprises and more like logical outcomes. You learn to ask the right questions. Who is in control? Who is running out of strength? Is the market building pressure or releasing it? The more you observe these patterns, the more natural they become. And the next time the market sits quietly at a key level, you will find yourself paying closer attention, recognizing the signs that accumulation or distribution is in play, and preparing for the movement that is likely to follow. When you study a market that is preparing for a breakout, one of the most reliable signals you'll ever find is the tightening and orderly structure that forms before the move. A true breakout rarely erupts from erratic, chaotic action. Instead, it grows from a period where price begins to move with purpose, calm, controlled, and almost restrained. This is the market revealing that energy is being stored, pressure is building, and one side of the market is quietly taking control. And let me ask you, have you ever seen a tight, disciplined price structure form and wondered why the market suddenly becomes so quiet before a big move? When a market becomes orderly, the candles begin to contract. Wild swings settle into measured movements. The highs and lows begin to form a clearer pattern. This happens because traders, especially large operators, prefer to build positions without stirring unnecessary attention. They allow price to consolidate in a tight range, absorbing supply or distributing it without creating major disruptions. This natural compression is one of the clearest signals that the market is preparing for something significant. Have you ever noticed how the market almost whispers before it speaks loudly? As price action tightens, volatility drops. This is important because volatility reflects the emotional state of the market. High volatility means uncertainty and imbalance. Low volatility means balance, patience, and preparation. Markets hate staying in low volatility for too long. When price becomes compressed, it is like a spring being pushed inward. Tension forms, and eventually it must release. A breakout simply becomes the moment when that stored energy finds direction. but the direction usually becomes clearer long before the breakout itself. You can see it in the structure, you can feel it in the behavior of the candles, and you may have caught yourself observing a tightening structure while thinking, "This feels ready?" Even if you didn't yet know why. This orderly behavior also reveals the intentions of stronger participants. They prefer markets that move cleanly because it allows them to execute positions without slippage, without chase, and without drawing in emotional traders too early. Through the tightening structure, they create conditions that reduce noise, making the eventual breakout more efficient and more likely to follow through. The average trader, however, often ignores this phase because it appears slow and uneventful. Yet this very slowness is the foundation of the explosive movement that follows. How many times have you ignored consolidation only to watch it erupt the moment you looked away? Tightening price action also tends to form a sequence. Higher lows pressing into resistance for bullish breakouts, or lower highs pressing into support for bearish ones. Each approach toward the level shows diminished resistance from the opposing side. Buyers or sellers become increasingly aggressive, stepping in earlier and with more confidence. The repeated pressure weakens the level and reveals the underlying strength behind the market's intentions. This is why the market often pauses near a breakout point rather than instantly breaking it. It's testing, gathering conviction, and confirming that the opposing side has run out of energy. Do you recall a moment when price kept returning to a level like a persistent drumbeat until it finally broke? Along with tightening structure, the market displays clarity through cleaner swings. The noise disappears. The chart reveals balance, rhythm, and proportion. When bars shrink, wicks shorten, and corrections become shallow, these are not random occurrences. These are signals that uncertainty is leaving the market. Traders who understand price action see this as a sign that the market is organizing itself. Disorder rarely precedes a strong breakout. Structure almost always does. And I wonder, have you realized how much order reveals about the true intentions behind price movement? Another hallmark of an orderly pre-breakout structure is the formation of a decision zone. This is when the market narrows into a wedge, flag, or range so tight that it becomes clear that a resolution is near. But what matters more than the pattern itself is the behavior within it. The cleaner the action inside the zone, the more reliable the breakout tends to be. Patterns with messy, oversized bars or erratic spikes often fail because they show conflict rather than control. In contrast, a tight structure with controlled bars suggests cooperation among large traders, not conflict. Have you ever seen a messy chart produce a clean breakout? It's rare, and that rarity reveals the importance of structure. Orderly tightening also reveals market confidence. A market drifting sideways without volatility shows patience rather than fear. It indicates that participants are willing to hold positions even as price moves little. When fear dominates, the chart becomes unstable. When confidence dominates, price becomes smoother. This confidence is often a precursor to a decisive breakout because confident positions are the ones that lead the next leg of the move. Think about the last time you observed a clean build up before a breakout. Didn't the breakout itself feel almost inevitable once the structure was clear? Finally, when traders learn to identify this orderly build-up, they stop trying to predict breakouts and instead learn to recognize them as they form. This changes everything. Instead of guessing, you are observing. Instead of chasing, you are preparing. Instead of reacting emotionally, you are reading the structure like a map. And this map, when read correctly, points to the path of least resistance, the direction in which the breakout is most likely to move. As you continue studying charts, you will begin to notice how often the market gives you this orderly warning before the breakout reveals itself, and how recognizing that tightening structure can shift the way you approach every potential setup. When a market tests a level repeatedly, most traders see it as nothing more than price bouncing around the same area. But if you've studied enough charts, you know that each test is telling you something about the strength of the participants behind the move. Each touch of support or resistance is not random. It's a measurement of whether buyers or sellers are gaining or losing conviction. And if you start paying attention, you'll notice that every additional test increases the significance of that level. Have you ever watched price return to the same zone over and over and wondered why the market seems magnetized to that point? When a level is tested multiple times, it becomes more important because it represents a clear battleground. Buyers defend the same support, sellers defend the same resistance, and every return to the area chips away at the power of those defenders. Markets don't revisit levels out of habit. They revisit them because the underlying tension has not yet been resolved. Each touch of resistance shows that sellers are still present, but also reveals that buyers haven't given up. Each touch of support shows that buyers remain strong, yet it also hints at the persistence of sellers pressing downward. And when you look at it that way, the market begins to feel like a negotiation, doesn't it? Think about how a door works when it's locked. If you push on it lightly, it stays shut. Push again with a bit more pressure, it still resists. But push repeatedly, stronger each time, and eventually the lock weakens, the hinges flex, and the door finally swings open. That is exactly how support and resistance behave. The more the market pushes, the weaker the level becomes. Many traders mistakenly assume that the more times a level holds, the stronger it becomes. But in reality, every retest drains the strength from that level. Have you ever believed a level was strong right before it broke, because you overlooked how many times it had already been pressured? When buyers push into resistance again and again, without being forced back into deeper lows, it reveals an important shift. Sellers are being absorbed. Their orders get filled, their supply thins, and eventually there is not enough left to defend the line. That is why multiple touches often precede strong breakouts. The level becomes well defined, widely recognized, and increasingly fragile, and once it breaks, the move often accelerates because so many traders were watching the same line. Some were trying to fade it, others were waiting to enter, and still others planned to exit losing positions. All this activity creates an emotional surge when the level finally gives way. Can you recall a time when a breakout ran sharply simply because everyone had their eyes on the same zone? In the same way, when price repeatedly returns to support, the buyers who defend it begin to reveal their strength. But with each defense, the sellers pressing downward gather information too. They learn how much demand is sitting there. They test it, they probe it, and they eventually exhaust it. When support finally breaks after several tests, it usually breaks with speed, because everyone who had been relying on that level suddenly realizes that the floor is gone. And have you ever noticed how quickly markets fall when a widely tested support finally fails? These repeated tests also provide clarity about the trend itself. In uptrends, resistance becomes the obstacle. If price keeps returning to the same ceiling, it often means buyers are becoming more aggressive. They step in earlier, lifting the lows, tightening the structure, and revealing demand building beneath the surface. In downtrends, the same logic applies to support. Sellers grow more persistent, the highs drop, and price gets pulled downward like gravity. The more times a level is touched within an existing trend, the more meaningful the eventual breakout tends to be, because it represents the continuation of a force already in motion. Do you ever notice how repeating patterns within a trend create some of the strongest breakout opportunities? Another benefit of multiple tests is the psychological clarity they bring. Traders love well-defined levels. They create clear expectations, clean entries, and obvious stop placements. When the market outlines a level with repeated touches, more traders become involved. Some place stop orders behind it. Some place limit orders at it. Some simply watch. This builds liquidity around the area, which is necessary for a strong breakout. A breakout cannot occur without liquidity. It needs participants willing to transact on both sides so that the dominant force can push price beyond the boundary. Think about how many breakouts fail simply because they occur at levels nobody cared about. Repeated tests also help you distinguish between genuine pressure and simple noise. One test might be a coincidence. 2 tests might be luck. But 3, 4, 5 touches begin to show intention. The market is communicating. It is telling you where the battle is taking place and which side is gaining momentum. When the touches come with higher lows pressing against the same resistance, or lower highs pressing against the same support, the directional bias reveals itself. Tightness plus repetition is one of the strongest combinations you can find in price action. It shows that the market is preparing for a shift, not drifting aimlessly. Have you ever noticed how much more confident you feel entering a breakout after you've watched the structure build over time? The more you pay attention to these repeated tests, the more natural it becomes to anticipate the moments when the market is nearing a turning point. You stop relying on guesswork. You stop reacting emotionally to shallow pullbacks. Instead, you begin to understand where pressure is building and why the next test might be the one that finally gives way. You begin to read the market's intent through its behavior rather than through prediction, and that change in perspective can transform the way you approach every potential breakout setup. When you're studying a breakout and trying to separate the strong moves from the weak ones, one of the clearest signs you can rely on is the behavior of the breakout candle itself. A breakout candle that closes near its high is not just a candle, it's a statement from the market. It shows conviction, strength, and a decisive shift in control. Price isn't slipping back, it isn't hesitating, and it isn't being pushed around by opposing orders. It's moving with purpose, and the close near the high shows that buyers maintained pressure throughout the entire session. And let me ask you this. How many times have you seen a market break a level only to fade immediately because the breakout candle showed hesitation instead of strength? When price pushes through resistance, the way it closes matters because the close reflects who won the battle during that period. If buyers truly had control, they don't just break the level, they defend it all the way into the close. That means sellers attempted to push the price down, but buyers absorbed every bit of that pressure and still managed to keep price elevated. That's the kind of behavior you want to see in a breakout worth trading. It tells you the move wasn't a fluke, not a stop hunt, not a temporary imbalance, but a genuine shift in direction. Have you noticed that candles with long upper wicks and weak closes rarely produce strong continuation? A strong close near the high also signals that the breakout level has effectively flipped from resistance into support. Market psychology shifts instantly when price breaks and then holds. Traders who were waiting to short the resistance now find themselves on the wrong side of the move. Traders who are hesitant to go long now feel forced to act. The market becomes directional because conviction has replaced uncertainty. And think about it, if the breakout candle closes weak, what does that tell you? It tells you resistance might still be intact. It tells you the market broke the level but didn't earn the right to stay above it. Weak closes whisper caution. Strong closes speak confidence. Have you ever been lured into a breakout by the mere price poke, only to see the candle close weak and the move collapse? The close near the high also eliminates much of the noise that can distract traders. Many breakout attempts look promising during the early part of the candle. There's an initial push, some momentum, maybe even a wick through resistance. But the final close strips away the illusion. It tells you who had control when the dust settled. A market can poke above resistance 3 times in one candle, but if it closes back below the level or far from the high, the breakout is nothing more than noise. On the other hand, even a modest breakout candle becomes meaningful when it closes strong. The close carries more weight than the intraday movement because it represents the final agreement between buyers and sellers. And I wonder, do you judge breakouts by how they look in the moment or by how they end the session? A strong closing candle also helps filter out false breakouts. False breakouts typically show inconsistency, strong pushes followed by sudden retreats. They lure traders in and then reverse quickly. But when the breakout candle finishes near the high, it shows that buyers didn't just make noise, they followed through. They committed. This reduces the likelihood that the move is a trap designed to catch emotional traders chasing the breakout. It provides a higher probability foundation for entering the next leg of the trend. How many losing trades could you have avoided simply by asking whether the breakout candle closed strong? Another important aspect of a strong close near the high is its impact on market participants who use stop orders. When the candle closes near the high, it signals that breakout traders, trend followers, and momentum traders are more likely to join. This surge of participation provides fuel for continuation. A strong candle creates a sense of urgency that draws in more buying pressure. In contrast, a breakout candle with a weak close often does the opposite. It creates doubt. Traders hesitate. Volume dries. Continuation becomes uncertain. Can you recall times when a lukewarm breakout candle left you unsure whether to act, while a strong one left no room for hesitation? The strength of the close also reflects the absence of aggressive sellers. If sellers were strong, they would push price back down before the candle closed. But when price finishes at or near the high, it shows that sellers were unable to create meaningful resistance. They may have tried, but their efforts were absorbed and overpowered. This imbalance is what creates follow-through. A breakout isn't just about breaking a level. It's about breaking the level and proving that the opposing force is no longer capable of holding price back.